Hello and welcome back to Money Talks, your guide to the Canadian securities. In today's episode, we'll talk about equity transactions. Hey Alexis, great to have you back on the show. How's everything going?
Hi Rita, it's great to be back. Things are going well, thanks for asking. Always a pleasure to be here.
We've been getting some fantastic feedback from our listeners, and I just want to say a huge thank you to everyone who has been tuning in, commenting, and sharing the episodes. If you're enjoying the content so far, please don't forget to subscribe and give us a like. It really helps us out.
Absolutely. The engagement has been wonderful to see. It's great to know we're helping people navigate the world of Canadian securities.
Speaking of which, I've been thinking about equity transactions lately, but honestly, they seem a bit intimidating. Can you break it down for us?
Of course, Rita. It's a topic that sounds more complicated than it is once you get the hang of the basic concepts. Think of it like learning the rules of a new board game. A little complex at first, but it opens up a whole new level of strategy.
I like that analogy. So where do we start? What's the first thing we need to understand about equity transactions?
The very first thing is understanding the type of account you're trading in. Most people start with cash account. It's pretty straightforward. You buy a stock and you have to pay for it in full by the settlement date.
And the settlement date is when the actual exchange of money and securities happens, right?
Exactly. For most securities in Canada, it's one business day after the trade happens. Now, the other main type of account is a margin account. This is where it gets a bit more interesting.
Margin, that's where you can borrow money to invest, isn't it?
That's the one. A margin account allows you to buy or sell securities on partial credit. You pay a portion of the purchase price and your investment dealer lends you the rest, charging you interest on that loan, of course.
So why would someone choose a margin account over a cash account? It sounds a bit riskier.
It definitely involves more risk, and we'll get into that, but the main draw is leverage. It allows you to control more securities than you could with just your own capital. This brings us to the concepts of long and short positions.
Okay, I've heard those terms thrown around a lot, a long and short.
In simple terms, a long position is what most people think of when they think of investing. You buy a stock, you own it, and you're hoping the price goes up so you can sell it for a profit later. You can have a long position in both a cash and a margin account. A short position, on the other hand, is a bit different and can only be done in a margin account.
This is where you're betting the stock price will go down.
Precisely. With a short position, you're selling a security that you don't actually own. Your brokerage firm lends you those shares to sell. The goal is to buy them back later at a lower price, return the borrowed shares, and pocket the difference as profit.
Can you give us an example of how margin would work in a long position?
Absolutely. Let's say you want to buy 1,000 shares of a company called Innovate Corp, trading at $25 per share. The total cost is $25,000. Regulations might require you to put up 50% of your own money as margin, so you would provide $12,500, and your dealer would lend you the other $12,500. You now have control of $25,000 worth of stock with only $12,500 of your own capital.
And if the stock price goes up, your gains are magnified. But what happens if the price drops?
That's where the risk comes in. Let's say Innovate Corp drops to $22 per share. Your 1,000 shares are now worth only $22,000. Your dealer's loan is secured by those shares, and since their value has dropped, the maximum they're willing to lend against it also drops. They'll issue a margin call.
The dreaded margin call. So that means you have to deposit more money.
Yes, and quickly. The firm needs to ensure the original purchase price is covered. With the stock at $22, their maximum loan might now only be $11,000, 50% of the new lower market value. You originally put up $12,500. To cover the shortfall, you'd get a margin call for $1,500 to bring your account back to the required level. If you don't meet the call, the dealer can sell your shares to pay back their loan.
That makes sense. Now, what about short selling? Can you walk us through an example?
Of course. Let's say you think a company, Retro Gadgets Inc., is overvalued at $50 a share. You decide to sell short 100 shares. Your broker lends you those 100 shares, and you immediately sell them on the market for $5,000. That cash sits in your account as collateral, and you also have to deposit your own margin. A few weeks later, you were right. The price of Retro Gadgets drops to $40 a share. Now you buy 100 shares on the market for $4,000. You return those shares to your broker to close your position. You sold for $5,000 and bought for $4,000, so you've made a $1,000 profit minus interest and commissions.
But if the price had gone up to $60, you would have lost $1,000. And since there's no ceiling on how high a stock price can go, the risk is theoretically unlimited.
That is the single biggest risk short selling. It's a high-risk, high-reward strategy.
So once an investor decides to buy or sell, how do they place the order?
They have several options. The most basic is a market order. This tells your broker to buy or sell at the best available current price. For example, if a stock's bid price, what buyers are willing to pay, is $19.90, and the ask price, what sellers are willing to accept, is $20.10, a market order to buy will likely be filled at $20.10.
So you get your shares right away, but you pay the higher price. What if you want to be more specific?
Then, you'd use a limit order. You specify the exact price you're willing to trade at. Using that same stock, you could place a limit order to buy 100 shares at $20 or less. Your order will only be filled if the ask price drops to $20. The downside is if the price stays above $20, your order might never be filled.
And you can specify how long the order is good for, with a day order or a good till canceled order, right?
Correct. A day order expires at the end of the trading day, while a GTC order can remain active for up to 90 days.
What about those stop orders I've heard of for managing risk?
Those are very important. An on-stop sell order, also called a stop-loss order, is an instruction to sell if a stock's price falls to a certain level. Let's say you bought Innovate Corp at $30 and you want to limit your potential loss. You could place a stop-loss order at $24.50. If the stock price drops to $24.50, your order is triggered and becomes a sell order to get you out of the position and prevent further losses.
So it's like a safety net. What's the opposite of that?
That would be an on-stop buy order. This is an order to buy a stock once its price rises to a certain level. It's used for two reasons. First, to protect a short position. If you shorted retro gadgets at $50, you might place a stop buy order at $55 to automatically buy the shares back and cap your losses if you were wrong. The other reason is to buy it to a stock that's showing upward momentum. A trader might say, I'll only buy Innovate Corp if it breaks through the $35 price level. They place a stop buy order at $35. The order is only triggered if the stock shows the strength to hit that price.
Wow, that's a lot to take in, but the examples make it so much clearer. It really shows how many tools are at an investor's disposal.
It really is, and understanding these tools is the first step to building a coherent and effective investment strategy. It's all about knowing your options and the risks associated with each one.
This has been incredibly insightful, Alexis. Thank you for making equity transactions so much more approachable. To our listeners, what are your thoughts on using margin or short selling? Have you ever used a stop-loss order to protect a position? Share your experiences in the comments below. We'd love to hear from you.
Thanks for having me, Rita.
And as always, a big thank you to our audience for tuning in. If you found this episode helpful, please like, subscribe, and share it with someone who might also find it useful. We'll be back next week with another episode of Money Talks.